Over and over again, courts have said that there is nothing sinister in so arranging one's affairs as to keep taxes as low as possible. Everybody does so, rich or poor, in all due right, for nobody owes any public duty to pay more than the law demands. Taxes are enforced exactions, not voluntary contributions. To demand more in the name of morals is mere cant. I found that opinion a few years ago and I kept it. I wrote it down because I thought it was really interesting, and it's true. Nobody wants to pay more taxes than they have to. But you don't want to not pay taxes when you have to and do something illegally and get in trouble with the government. You don't want that either. But there has to be a balance, right? In the last episode of this podcast, we talked about when and why you should hire an accountant, at what time you should hire an accountant. Well, in this episode, I want to talk about 10 red flags you should avoid as a content creator or as a small business owner, so you won't get audited or in trouble with the government. The information I share with you is based on my opinion, my own research and experience working as a tax professional for more than 20 years here in the state of Florida. But you should always hire a professional from your state that is licensed to work in your state, so they give you more information on how tax laws and regulations work in your country or even in your city. Alright, so let's start with the 10 red flags. Okay, the number one is kind of a personal thing, a personal opinion. Avoid using round numbers if you can. Now, if they're true, if the answer of an expense, a revenue, is a round number, then of course use it, because you're going to have a backup to back it up. You're going to have evidence to back it up. Try not to use them if you can, because that's usually like a red flag. It does catch the eye that you use a lot of round numbers. That's just something I wanted to put it out there because it's kind of my personal pet peeve not to use round numbers, because I think it does bring me attention and it could raise a red flag. It could ask a lot of questions and you don't want that. Number two, using large numbers and reporting a loss in Schedule C. Now, you don't know what Schedule C is. I'm going to talk more about it later in future episodes, but the Schedule C is a form that sole proprietorships fill out in their personal return when you are self-employed and you have your own small business, but it's not established as an LLC or a corporation. You file it together with your personal return, and that's where you file the revenue and expenses in your Schedule C. Now, you shouldn't use large numbers or large losses. Now, there might be a case that it is true your first year, but again, you have evidence that it is true, then use it. But try not to. Try to avoid it if you can, because it is a huge red flag when you have self-employment income and it's not income. You're reporting losses, especially huge losses, because it just brings up a red flag. It's showing, or it might be telling the IRS that you are reporting false losses to be able to lower your income and pay less taxes. So just avoid it if you can. It is a huge red flag. It's one of the most audited tax returns. This is about people that report as self-employed and they have losses in their Schedule C. And if you are reporting your self-employment income as losses, then you're telling the IRS that is not really our business. It's not an ongoing business. It's really more like a hobby, and the IRS would discard it and not consider it, and you'll have to pay all those taxes back. So just avoid it if you can. Another red flag is claiming an expense or you paid outside help without giving them a 1099. If you pay another person for a service more than $600 a year, you should give them a 1099. And I mean by a service like a subcontracted service, someone you hire on maybe multiple times. It's not like a one thing, like I pay my mechanic or my plumber or something like that. And that's not what I refer to. I'm talking about subcontracted services. Let's say you're a content creator and you hire a photographer to take your photos with you or for you, or take video for you. Maybe you pay an editor to edit your videos, things like that. It's something that you use multiple times, that you use ongoing, that you contract to do work for you. If you pay them more than $600, then you should give them a 1099. And this could be a red flag if you report those expenses and don't give them a 1099, because I have seen people that are getting audited, and when they show that they don't have a 1099, then they have to put back that money, and the IRS would disregard it and not use it as an expense. So it's going to be harmful for you, and you have to pay back all those taxes plus penalties and interest. So if you're going to pay somebody or you're going to expense that, you're going to report that expense, make sure you have a 1099 for that person. Number 5 has to do with a Schedule C and the 1099. It's when you report gross receipts on your own Schedule C less than what has been reported to the IRS. So let's say you have various companies that pay you with 1099 and they add up to a certain amount, but you report less than what is being reported to the IRS. You will get a letter and they're going to ask you for that difference, ask you why didn't you report that difference, and then you're going to have to pay taxes on that money plus penalties and interest for not paying or not reporting that income as you should. So that's something to keep in mind. If you get 1099s, then report what you get reported on. Number 6 is an important one. Well, they all are important, but I think this was one that is kind of easy to do and easy to fall on, is when you report meals and travel deductions are really high, like really large amounts. Like, let's say that it is true that you do travel because what you do, you're content creating and you have to travel to different places, then yes, of course, by all means report it. Your accountant and tax advisor, if they're professional and responsible, they'll be able to advise you on what amounts are excessive for your business. But that's something to consider. Like, don't go overboard, because that's a huge red flag. It's gonna get picked up and they're gonna notice that it's deductions that are really too high for the industry. So just be careful, be aware, and be reasonable on what expenses you expense. Number 7 is home office deduction. So if you don't know what home office deduction is, I'm going to briefly explain it. I personally try not to use this deduction with my clients because I feel it's something that is easily picked up by the IRS. But it's when you have a dedicated room for your small business. So let's say you work from home and you have your business at home and you have a specific dedicated room for that business. It has to have its own entry from like the outside. It has to have its own bathroom. That's what I think the regulations say. And then if it's true, you have those requirements, if it's a room dedicated just for that, and it cannot be your bedroom, and it cannot be a room that is dedicated for multiple businesses. It has to be just that business with its own entry and its own bathroom. Then what you do is you get the expenses from your whole house and then divided by the square footage. It's a little bit complicated and a little bit tedious, and I think it's not worth the trouble. But if that's something that you are considering or your accountant advises you, then you have an idea of how it works. If you want more in-depth information, I could talk about it in the future episodes, so let me know down below in the comments. Okay, number 8 is such a frustrating thing for me. It's such a pet peeve, and it's when you hire a person to do your taxes that has no idea of what they're doing. You're gonna get audited eventually. Maybe not, maybe you're lucky and you're not, but trust me, you don't want to get audited because it's time consuming, it's expensive, it's a big headache, and you just want to avoid it. So if you hire somebody that just because they promise you a bigger refund, or they promise you they're going to charge you very little compared to other tax preparers, it's a red flag, because that person doesn't have probably the software, the expertise, and they're going to include revenue expenses that are not correct just because they want you to get a bigger refund, or just to get it over with and just do your taxes, get their money, and you probably will never see them again. I've seen that so many times that it hurts. It breaks my heart in a way, because people trust their things to somebody, and then when they're in trouble, they're nowhere to be found. I've seen that so many times. I lost count how many times that's happened to us. So just be careful. Hire a professional. Hire someone that you could trust, someone that is licensed, has years of experience, maybe someone that you've been referred to by another content creator in the small business. Do that. Don't just hire someone off the streets, because you don't know who you're trusting. So just be careful. I've seen this before. If that one person gets audited by the IRS because of one of their clients, there has been times when the IRS would audit all their clients. So, you know, one bad apple, one bad pear, and might get you in trouble. So just avoid it. Hire someone, maybe you pay a little bit more, but hire someone that's going to help you in the short and long run and avoid you a lot of headaches. You don't have to be scared of the IRS, but you know, you just have to be aware that, you know, it's a headache to deal with them sometimes. So it's better to hire someone that knows what you're doing. Number 9 is not reporting digital currency. This is something relatively new, but it's also important because it's new. There's not a lot of information out there, so it's better to report it. Not reporting it will cause you trouble. So report any revenues you have earned from Bitcoin or other virtual currencies. Make sure you report everything on your returns. And if you have foreign accounts in a foreign country, which happens, maybe you have an account in your home country, or maybe you have a savings in another country, or you have a property in another country, make sure you report it, because even though that money is not taxable here in the US, only the gains, like if you have interest or dividends, that is, or if you sell a property, that is taxable here in the US if you are a US resident for tax purposes. But having money or a property is not necessarily a taxable event, so you don't have to worry about paying taxes, but you have to worry about reporting it, because the penalties are huge for not reporting financial accounts over an average of $10,000 or more in a year, or any property that you have outside of the US. You have to report it, and it's not going to hurt you, but not reporting it is going to hurt you, because the penalties are huge. The number 10 is a little bit difficult to explain, but I'll briefly explain it. Is when if you have a corporation or a small corporation and you pay yourself very little salary. Some shareholders, some owners try to get away with paying taxes by paying themselves distributions and not necessarily a salary. And that's a red flag. Maybe not in the first couple of years, but eventually it's going to hit you, because the IRS wants you to pay Social Security tax and Medicare tax, all that. So if you pay yourself distributions only, then you're only paying federal income tax and not Social Security and Medicare. So they're going to want you to pay yourself a salary, and you have to consider what is reasonable. Maybe if your business is not making money, you don't have to pay yourself a salary because you're not making money. But if you're making a small income, maybe pay yourself a small salary. But if you're making yourself a huge salary, a huge income, then big income, hopefully that's where we're all going to end up making profit, because that's what we want to do. Then pay yourself a salary that is reasonable to your income, and that's something your accountant could advise you on. A little side note on how the IRS audits or picks up returns to audit is what I'm going to say next is something that I've discussed with IRS agents, and as well as seminars that I've taken in the past that talk about how IRS audits and how they pick returns to audit is not something just random out of nowhere. Like, if they have a system, and I want to talk about it, and have my notes, and I'm going to read it because they have terms that I don't want to confuse or miss. One way they do it is called the DIF score, which is a DIF. It stands for discriminant inventory function. That's why I wanted to read it to you, because I don't want to mess up. Some returns are selected for examination on the basis on the DIF score. This system score rates the potential for change based on past IRS experience with similar returns. So what this means is that if they have had problems with certain returns, type of returns, like let's say self-employment individuals that report negative Schedule C's, they're gonna get similar returns with the same problem, because they're gonna see like what's the word I'm looking for? I didn't write it down, but they're gonna see like a pattern, and they're gonna the system that they use is gonna pick up the return, like a computer system. It's not like a person. A system is gonna pick up the return, and then an auditor will, or an IRS representative would actually look through your return. But the system will pick up returns that are similar in pattern. Another system they use is the UIDIF, the unreported income DIF. The system score rates the return for the potential of unreported income. IRS personnel screens the highest scoring returns, selecting some per audit and identifying the items on these returns that are most likely to review. So they have in their system any tax forms that have been reported using your name and Social Security, all your information. They have that in their system. So your tax return is going through their system, and then the system is going to pick up a return that has not reported all the income that has been reported on their forms. It's going to pick it up. So that's what the UIDIF score means. It's unreported income. It's going to pick it up, and then an IRS agent physically is going to go through the return. Another system that they use is called automated underreported or information matching. Some returns I examine because pay reports such as Forms W-2 and 1099s are wrong or missing. So in the previous case is when they see that certain revenue isn't reported, especially compared to other years. But like this one is more specifically if your W-2, your employer reported a certain amount and then the numbers don't match. Maybe you did report your W-2, but the numbers are not the same as what your employer reported. That's what it means when the numbers don't match. Not that you underreported necessarily, but that they just don't match. All right, and the last system, or the last idea, is related examinations. I kind of spoke about it or touched it briefly in this episode, but returns may be selected for audit when they involve issues or transactions with other taxpayers, such as business partners or investors whose returns were selected for examination, and also when you have an unprofessional tax preparer, clients will get audited. And that's what I mentioned earlier today. If I do a fraudulent tax return, or a lot of them, and the IRS picks up, they're gonna probably audit all my accountants, because you're, what's that expression, guilty by association. Yeah. So if they pick up, I did 20 fraudulent tax returns, just to give you an example, they're probably going to audit everybody, because you're going to say, well, this person probably did more than just 20. That's just an idea. I've seen it before. I'm like making it up. It's happened. So you got to be careful on who you hire. And the one I mentioned before is related. Let's say your business partner gets audited or been caught in something criminal or something like that, then the IRS would also take in consideration their business partner and audit them as well. That's something that I've barely seen, but it does happen. There are other red flags to avoid, of course, but I just wanted to concentrate on 10, the ones that I think are most important, or the most obvious. And I think these 10 red flags are going to help you in your business. If you have any questions or comments, of course, leave them down below. I might answer your question in a future episode. I hope you enjoyed this information. If you do like this type of content and want to hear more, want to see more, then make sure you subscribe, click on the bell to get notified of future episodes, because I have a lot of things to talk to you guys about, and I hope it's very helpful. If you missed my first episode, I'm gonna leave it right here for you guys to watch it now, or another video that might interest you. So thank you so much, and I'll see you next time.